All right, so I'm Foster Provo, as I guess you know. We're going to have the second panel of the afternoon, which is using alternative data for credit assessment and payment. On the panel, we have, I guess, from your left to right, we have Joe Breeden, who's the CEO of Prescient Models. Prescient Models, yes. Yeah. We have Alberto Corvo, who is the CEO of Motive Labs. And we have Eric Starr, who's a partner at CapEx Partners.
Good afternoon.
Hello.
Yeah, so good afternoon, everyone.
Our moderator is the lead singer of Mean Reversion, by the way.
Oh, thank you. Yeah. Mean Reversion, yes. You got to go check it out. Yeah, so besides my main job, which is my singing career, I'm a machine learning guy, and for 25 years or more, I've been looking at building machine learning models on alternative data for a wide variety of applications for some of the biggest banks in the world, for a whole bunch of startups, but I've never actually worked on using alternative data for credit assessment and payment. So I'm not really going to tell you much about my opinions on things. I'll leave it to our panelists. One thing that is out there that may be very helpful for some people is we did publish a case study that's intended for teaching purposes on using machine learning on lending club data to be able to see if you can build models to decide how you should build out your portfolio of lending club loans. So you can find that if you just sort of Google my name and lending club. But that was more an academic case study than a real application. So let's start talking about real applications. And I think maybe it's important, a good way to start is by about saying what we're really talking about here. And so what are these alternative data? How are they different from traditional data? What applications are we really talking about? And we've decided that we'll start with consumer credit. Maybe Alberto, can you tell us a little bit about like different ways in which alternative data can improve credit assessment and other things as well, if you'd like?
Yeah. So hi everybody. So the story here is working with banks and having been in the industry for a while. The challenge has always been there's some markets where there's a lot of access to what we would call traditional data or data to do credit assessment of corporates, of consumer data, or for lending goals. But the reality is that there's a lot of markets, and actually I would argue is the majority of the world population, where there's not really the type of data that you would imagine, like payment data or borrowing data or timeliness of payment. And so more and more banks and lenders at large have been looking for, okay, what are other ways for us to be able to assess the creditworthiness of someone that either arrived into the country a week ago or just it's never been banked. So we need to figure out other ways. And we've been working with banks in the Emirates, in Brazil, in India, to bank the unbanked and to create credit for people based on social media, based on other types of approaches. Some of them are public, some of them are less public, but is how do you grab data that is not the classic data and then extrapolate, okay, is this a good payer, is this a bad payer? And also, how do you actually use data that are non-traditional data, like the FICO score in this country, to extend the credit and actually understand and adjust on a constant basis? Because a lot of times what happens is that it goes away, and then while they pull your credit data, but then unless they pull it again, they don't know, and maybe a lot of things happen, so there's a constant adjustment needs to be done. So it's two really tendencies, extend credit and assess and continue reassessing credit. That's been what we've been working on for a while now. So.
And Joe, you've been investigating a bit the difference between non-standard data and what you called near-standard data. I wonder if you can tell a little bit about that.
Sure. We do work with clients around the world, but focus on the U.S. for a minute, and there are different definitions of what alternate means. Clearly, some people have the sense that anything that isn't from the credit bureau, that isn't LTV, well, that's some kind of alternate data. And that could be. Others would say, well, it's social media data and, you know, what's your Airbnb rating and things like that. And mine's pretty good. So, you know, that's interesting too. But when we work with lenders of all sizes, big ones, small ones, corner shop. And, you know, on the one hand, they struggle with things like the cost of refreshing a FICO score. Their FICO scores may be out of date since origination on a 4-year-old auto loan. So ironically, one opportunity for using non-standard data is just anything that can fill in more costly data. And certainly in the underbanked, that's one thing that's happening, is that FICO scores are not really applicable for the thin file and the underbanked. So what does that mean? What do we look at? Well, one of my roles is I sit on the board of directors for a company called Upgrade, which is a FinTech that originates personal loans. And I'm not going to say anything that they do specifically, but just sitting in that universe of, you know, Lending Club and Upgrade and these others, often what they're doing is what might be non-traditional, but it's really kind of near traditional. When you apply for a loan, they'd like access to your checking account. And they've got an algorithm, sounds fancy, but really they're just going through to figure out the payment frequency and the volumes monthly. And can they figure out what your paycheck is? Well, most of the time, yes. And so is that non-traditional alternate data? Well, not really. Your regulators won't care, won't mind that you're doing that, depending on the regulators that they have to talk to. So some of those things, not too surprising. Another example of a credit union. It's surprising how many credit unions are actually subprime lenders. So this is a credit union who is 80% subprime auto loans. And one of the things they look at is they have a contract with a company that can tell them if you're making your insurance payments. And if you're not making your insurance payments on the car, there's a good chance you're not going to pay for the loan on the car. So risk goes up, right? So those are kind of, again, regulators won't mind, but they're looking at that. It's not at all like the more exotic type of information. I think we'll talk some more
about that, yeah, in a little bit. Okay, so, and I think actually something that is, you know, we need to talk about a little bit first before we dig into some of the details, is just, it seems that, based on what you guys have said already, that we have a difference between the opportunities and the restrictions in the US and other developed countries versus in the developing countries. So I wonder if you guys could talk a little bit about that.
Yeah, so one thing that you got to think when you talk about alternative data is also there's a dimension of trustworthiness of the data source. So you have, you know, you get a FICO score, it's a FICO score, it is what it is. But then you have trusted data, semi-trusted data, trusted sources, semi-trusted sources, the timeliness of when you got the data and how you got it, that factors in. So when you go to emerging markets like we're doing a lot, it's really, most of the data, it's dirty to start with. So there is some signal, but there's a lot of noise. And then you got to get a lot of data points about an individual and about the population to be able to make that inference. Whereas I think that when you go to more evolved markets in some ways, you can have, okay, I have something that I can hang my hat on. It might be old, but at least it's something that, and then it becomes a work of updating. Okay, this guy has started slowing the payments, or I can tell from his LinkedIn profile that he lost his job, or that he had one more kid. And then all these things are starting to factor. So the spending profile is different. So how do I adjust my credit? But there's some people, for one of our partners in Dubai, is like, there's laborers that arrive the week before and they got to buy a car. So now good luck. How are you gonna do that? And then the data you can extract, it's dirty by nature, and sometimes people try to game it. So there's a lot of machine learning at work here, is how do you eliminate a lot of the chaff and try to get the wheat that is actually the information.
And what about, for instance, from the regulatory perspective? I had some colleagues who did a study looking at improving credit scoring using social media data, and we'll get a little bit more into some of the details of what sort of data in a minute, but if it's sort of fine-grained data on what you're doing on social media or what's on your profile, right, which, as far as I understand it, is being done in some countries. I mean, but it can't be done everywhere, and so are we seeing that kind of difference between what's being done in different parts of the world? Do we know?
Well, I do know that there are lenders, especially in what we would call developing countries, where they're, as you were saying, less access to data, and they necessarily have to use that kind of information, and there's a social benefit to that because more lending to people who wouldn't otherwise. In the U.S., people think that finance companies can be more creative because they don't have bank regulators sitting on their doorstep. At the same time, I know some of those finance companies, they want to resell those loans to people who are regulated. And so they say, no, we stay away from that because we want to resell to banks and credit unions and others. So I feel like there's less actually going on than the marketing would say, to tell you the truth, that some people who make a lot of noise about it may not be using it quite as much as they say.
Alberto, you had said something to the effect of maybe the emerging banks might be further ahead than banks in emerging markets may be further ahead than maybe the banks in the more developed.
Yeah, I mean, they had to make a virtue of a necessity. And so, like it or not, and regulators right, regulators are a little more lenient because they understand the reality of what's going on. And if they want to inject some credit into the system, that's the only way to go about it. It's also a very important point. A lot of these lenders in emerging markets, they carry the risk. They don't package it. There's no secondary market for the risk. So at the end of the day, it's, I'll get my data, I'll try to figure out a way to price it, and then I'll extend the loan, and then I'll carry it, and I'll suffer the consequences or make the money. And but yeah, it's really night and day. And it's incredibly interesting what these people are doing, and the accuracy they are getting, and the type of data they do. I mean, there's they were looking if the first purchase that people make after having gotten a line of credit is fuel for the car, they know that's already a bad credit. They can't tell you why, they can explain it, but that's the numbers say that the risk all of a sudden went up. And so, again, it's a constant improvement, and yeah, it's miles and miles ahead. Also, there's no need here as much.
So we've been talking about consumer credit. Let's move on to lending to businesses, because although some of us, I think, immediately start to think of consumer credit when we think of credit, of course, that's just only a portion of the credit market. So Eric, you've looked a good bit at lending to businesses. Can you tell us a bit about the application of alternative data, and maybe whether there's a particular segment of businesses where it's particularly adds particular value?
Yeah, so at CapEx, we are a balance sheet lender, so we lend directly to commercial customers. For 20 years, really, we focused on what's called the middle market. And these are pretty large businesses within the context of FinTech, $2 to $25 million deals. But that being said, we do look at some of we're starting to look more and more at these small and medium-sized enterprises where there's much more alternative data sets available. Think of your Yelp scores or Glassdoor, things of that nature. That not Glassdoor, but Yelp, where you can get some lift in your credit modeling, your predictions for credit quality. But that's not where we live a lot. Where we live is, again, in the middle market. And I'll pick up where Joe touched upon earlier, and that is alternative versus kind of alternative data. In the middle market, which is, think of it as the third of the U.S. economy, those businesses, the amount of lending that goes in there is enormous. But what's really challenging and what makes it really difficult, and why you do not hear about it at FinTech conferences, is nobody's lending $25 million on a FICO score. Right? You need the traditional information. Now the problem is that means financial statements. And these companies are private. So if I ask 5 companies to send me their financials, I'm going to get 5 completely different sets of data in different forms. What do I do with them? Well, the model is you hire credit analysts that type the data into your model, and then you start doing your credit analysis. Well, what's happening now is through the use of AI and machine learning, is capturing this analog, unstructured data of traditional information and organizing it in a way that can be crunched, that can be analyzed using technology. So it sounds like, oh my God, this is like 10 years ago. But it's 1/3 of the US economy's lending marketplace, and it's just now coming into this FinTech space. So you're going to see a lot of growth in this. And we're starting with the traditional data. So that's the traditional stuff. Then what's also happening, because it's almost easier to capture alternative data than it is to capture this traditional data, we're seeing a lot of growth in that area as well simultaneously. And that information are things like, some of it we've heard about this afternoon, but what's going on in employee growth? Are they hiring more people? Are they releasing new products? Are they attending conferences? Are they speaking at conferences? And all of this data is now, through the use of AI, is being scraped and put into separate data sets, which then can be incorporated along with now this digitized financial information to arrive at credit scoring models that are far more automated than have ever been before. So that's what's going on in the middle market. And again, in the small and medium-sized enterprises, there's still a lot of the consumer-facing data, again, the Yelps of scores and whatnot, that are being used and have demonstrated lift in that space. But again, that's not an area where we're currently living in, but there's a lot of activity going on in the middle market, and it's really untapped, and you're about to see a lot of growth in that space.
And so do you see, I mean, I don't know how many years ago, 15 years ago, when the hedge fund, sort of industry was kind of transformed with the ability to go and gather different sorts of data, like the famous story being, looking at how full the parking lots were from satellite images, but there's many examples that are similar to that. Are we seeing that kind of stuff start to, or maybe it's already been happening for a long time in issuing credit to businesses?
No, I think what you're seeing is, I'm not in a room with middle market lenders, right? Nobody here a middle market lender? Okay, good.
Let's talk about them.
The vast majority of middle market lenders are ostriches who are running on the treadmill to oblivion. They have no idea that this stuff is coming down the pike. It's relationship lending. It's going out for more coffees and lunches and dinners. And the fact that data and AI and machine learning can essentially replace a lot of the jobs and roles that are traditional is just completely foreign. So there are some, and by the way, you can go outside of this country. China does a pretty good job of this. But the US or in North America, it's really slow it's really, really slow. And we'll see. I mean, that's why I love it. I love this stuff because the opportunity is there. Remember, it's 1/3 of the US economy that I'm talking about. Yeah. It's gigantic.
So I thought we might give something a try. So a lot of times when we talk these days about AI and machine learning and data and all that, we sort of talk at a rather nobody here, of course, talk at a rather superficial level. I was wondering whether we could sort of dig down and start to ask, what about some very specific examples of specific sorts of data for specific applications, and why does the alternative data actually allow us to do things better? Anybody want to take a stab at it?
Well, sure. So as I was talking about it, it's the challenge is people have never been in a banking system, in a banking ecosystem, and you want to bring them into this ecosystem. And how do you how do you extend that credit? So there's two steps. First of all, is making sure you can connect to them in some way and make it interesting for them to do it. And the second term is, okay, at what price this becomes a good idea and what's their ability to repay. And so it's not only alternative data in the scoring, and as we mentioned a bunch, and depending on the type of client that you're going after, it's social media data, which can be from Facebook to LinkedIn to having an app that they gotta download into their phone, because obviously they skipped a generation of phones and now everybody has smartphones, and you say, okay, if you want to be into the system, you got to download this, and the app spies to death. But that's what helps. But also is, okay, now you're walking into this kind of you're a small time contractor and you're doing work, and then okay, you're going to a place where you can buy material for your construction. Okay, so instead of trying to float it with the money that you're trying to get from the client that is paying you and paid you, how about we look at your population, people that are similar to you, you're going to need X amount of money. Let us float it to you. And this is how much you're going to pay, and this is how you're going to pay. And then it becomes seamless. This is up and running, actually. This is happening. People are pitching this actively. Or like people that do, I mean, it's kind of Uber-like kind of services. Okay, you've been driving X thousands of miles. From our analysis, you're going to need to repair the car, and this is how much you're going to need, and we're going to extend you credit, because we know that you work X number of hours, because we know that you're actually bringing money. So those are real-life examples that are happening, and in the consumer credit market that here we're not seeing because there's no need yet. But it's that's a big source of revenue, because the margins are actually pretty good, and the algorithms are actually pretty accurate. I mean, time will tell, but I would like to see 5 years defaults on these things. A few years from now, what was it?
So I'll just chime in there for
Please.
Think about alternative data sets with respect to lending, and let's make it simple that there's two types of loans that are made. One type is because that borrower is growing and they need access to capital, whatever that growing means, right? It could be personal, could be consumer, could be commercial. And the other is they need liquidity. They need money because they don't have enough of it. Now, you would want to lend liquidity because they have capacity to borrow more, right? They have the liquidity, it's just not tapped. So there's untapped liquidity. You don't want to lend if they don't have any more liquidity. So now you can use alternative data sets, again, to get back to to answer your question. You can use alternative data sets to understand where that borrower is in that continuum of growth versus liquidity. Now, it gets more challenging as, well, do they have the availability on the liquidity side? But you can use alternative data to figure out if you're on the growth side or the liquidity side of that continuum. On a consumer side, I mean, you can look at social media data. Are they taking more vacations? Are they, and on the flip side, it's like, do they have more children? And now it's, you know, it's growth in one way, but not necessarily in another. And so you can use social media to help you arrive at whether or not this is a growth type of customer or a liquidity type customer.
Thanks. And I mean, when you look in other industries and the sorts of data that are where we consistently see big improvements when you actually apply, I'm going to use the application of machine learning in this case. When you apply a machine learning to data, very often it's where you kind of move to a different sort of data, and that is very massive, very fine-grained data. So we saw this in online advertising when you went to things like every web page that people visit. And you look at it, that's so fine-grained, and it has a real, it describes at very fine granularity exactly what people are thinking about, sort of, because that's what they're clicking on. I mean, up to a certain extent, right? You look at when the mobile data started to become available, and now you see where people are all day long, you know, except for those of you who have the the ability to turn your phones off. You think turning your like GPS location off keeps people from finding out where you are? Sorry, if you're on the Stern Wi-Fi here, all there needs to be is one other of you who has your GPS on, and then we know where everybody is who's on this GPS, right? You look at banks, and when, you know, if you move towards from aggregate sociodemographics and so on about individuals, and you start to put in what are the actual merchants that they're transacting with, right? In all of those cases, we see big jumps in the ability of the models, right? And I guess what I don't know is whether these sorts of ultra fine-grained data, from the purpose of getting lift, whether we're getting, I mean, I understand we have these two different things that we were talking about earlier. You just don't have enough data, a thin file business or a thin file individual, and then you have somebody who potentially has a lot of traditional data, but we may be able to get a lot more lift. And so yeah, so I wonder if we could talk a little bit, maybe Joe, about getting more lift from models, whether it's through the kind of data that I've seen giving a lot of lift, or through some other way.
Yeah, in fact, there was a talk this morning where we heard about increased lift through some alternate data compared to just FICO scores. And we think about this in two dimensions, if you will. A lot of people, when they are looking at alternate data, well, that's pretty recent stuff. And these, you tend to have kind of point-in-time models. When we talk about lift, it's on a narrow slice of time, how much better can I distinguish different consumers. One thing we like to look at is change through time. Over long time periods, what can we say about how creditworthiness has changed and our ability to capture that? I'm a physicist by training, and we like pictures, so I'm going to grab the clicker there. They let me have a couple pictures. I like pictures. So this picture is this is a couple different studies we did glued together. The first study was done at the end of 2005, which was kind of an ominous moment to do a credit cycle study. In fact, at the time, in early 2006, I was showing that to everybody I could, and people nodded nicely and so forth. But what this slide shows you, this is specifically mortgage data, and it's a couple different studies sutured together, but that blue line is the credit cycle. Now, it's not FICO score. It's taking mortgage loan performance by vintage. The axis here is origination date, the x-axis. And so it's saying for loans originated in a certain date, no matter how old they are, whether they're recent or old loans, you normalize for the economic conditions, you normalize for how old the loan is and the life cycle effects, and you get down to a kind of intrinsic credit quality. But we don't know why. We only know what. So this is a good way to measure what was originated industry-wide. And you see, a huge cycle here. The axis on the left, that's actually change in log odds of default. And so if you do a little math, you'll find that that's a huge range that these loans are varying through. So what this says is, in 1994-95, that this sharp drop, bad quality loans were booked right before that kind of near recession that we had in 95. Then in 2000, 2001, end of 1999, another pretty dramatic drop in credit quality. And when we started working a lot with vintage models like this, everybody was saying, what's wrong with our 2000 vintage? People didn't understand because the FICO scores hadn't changed. And so in a static average FICO score environment, what's going on? Where are the bad loans coming from? And again, there are a lot of explanations about the mortgage crisis, and they're all correct, honestly. Was it the moral hazard of securitization? Yes. Was it the collapse in house prices? Yes. But you'll notice the credit quality deterioration began back in 2004, 2005. We were well into bad loans by end of 2005. And this is before those other things happened. This was still a good economy, but with bad loans. And you'll also notice the volume being originated, that's that red line. When we got good loans, we're getting high volume. When we get the bad loans, we're getting low volume. And that happens all the way through. So why is that? And it's important to note that these drops in credit quality are always right before the recession. They're not during the recession. In fact, we get good loans during the recession. So this, you could call this alternate data, but it won't help you in loan origination. It's not distinguishing consumers. This is the Senior Loan Officer Opinion Survey that the Fed runs. And I love the survey. It comes out every quarter. I need to check and see if it's out yet this month. But this is one of the best correlations to time series that I see in this industry, because every time that red line shows, every time consumer demand is dramatically falling, the quality is bad. And when demand is high, the quality is good, average quality. So what this means is that we've run this, we've got a paper that was published this year jointly with a researcher at the Philly Fed looking at this through the 2009 crisis. And what this is saying is that if you take a slice of FICO score, take a certain product, a certain slice of FICO, you still have a distribution of risk, right? Because FICO doesn't know everything, and that's what this talk is about. But it's saying as you go through the economic cycle, that distribution doesn't just increase or decrease symmetrically, it's asymmetric. That when the situation is not right, the risky consumers are left, but the good consumers stay home. And for mortgage, not right means interest rates are rising and house prices are going up too fast. And that's exactly what scared off the conservative consumers and left the other folks. So we get this, and I said they publish this regularly, so where are we now? It's worth noting that we are at stall speed right now in the economy. The economy is doing great, but from a lending perspective, the demand for loans is at neutral, and the arrow is pointed down, and that's for all consumer and all commercial. So this is exactly the point at which we see an inflection and we start to worry. But to the point of this panel, what I would like to use alternate data for is to find these people who are good when conditions are bad because maybe they had to move, so they're still the right people in the wrong time. I'd like to loan only to those, but there aren't very many. Or to find the ones who, they never really pay attention. They're only good if the economy makes them good, because when the economy changes, well, then I've got a problem. And so how do I filter them out? And it's not ever going to come from the Bureau, because the Bureau is the past. And there's something psychological here about demand for loans ties directly to the psychology of the borrower. So we do need alternate data to find this.
But I 100% agree. The other thing
Good,
that,
thank you.
well, I could also disagree.
But
there is a point where the type of data and the way we have approached data and the way banks and lenders thought about it was very punctual. So, something would happen, they would make an update in your credit record. You would buy something, here's a transaction, you bought something. But a lot of things happen in the middle. And what alternate data is trying to do is trying to catch what are you thinking. So you decided to go on a vacation and spend that money. What do you know that the bank doesn't know? Mm-hmm. Is it that you got a new job and this job involves a promotion, probably you made more money and you're celebrating? And that's what I think the big role of alternate data that still is not happening, particularly in this country, is how do you fill in that? And that you can extend it to other things like suitability when you talk about asset management. You can talk about insurance. How do you get this data that doesn't come with a transaction at the end? Because the banks thought they knew everything about everybody. No, you only know when I buy something. You don't know what made me buy or what things I didn't buy, what other options I considered. So you think I went for an X grand vacation, you think I'm overextended? Well, maybe I was looking for a 2X grand vacation, which is 2X overextending. So you want to know that the guy is crazy. Mm-hmm. So that's the thing, and that will help in what you just said, because it will help to start saying, okay, this is what people are thinking, and that's how we go get them.
I just don't want to, because credit cycle adjustment is more macro, and it's not necessarily alternative data. It's alternative data, but it's not the alternative data that we're talking about.
Exactly. This is meant to show the opportunity, but it's
right,
not the solution.
Right. I just want to make that clear
Yeah.
that there's a distinction here.
That's right.
There's credit cycle data, and then there's alternative data.
Right.
And I think one's micro, one's very macro. One is macro, one is very micro.
Yeah.
So in data science, people think about things like predicting future life events, which seems very relevant. I think the the infamous case, of course, is Target's predicting that someone will have a baby.
Yeah.
I mean, they're really predicting current pregnancy, but you could see it. But this is going to be a very big change in somebody's, in somebody's life. Wharton had this was maybe half a dozen years ago now, but Wharton had a competition where there was one of these data competitions where it was predicting life events, and you could find that I forget what the actual events that were very predictable were, but like an obvious one might be retirement. People just do certain things leading up to retirement, and I imagine these are the kind of things that could possibly address this opportunity.
Well, there's actually been some good psychological studies about the difference between a risk-taking psychology and a conservative psychology. And there's some evidence that might be what we're looking at here, that at certain points in the economic cycle, the conservative consumer stays home. And I always put this in the context of a dinner party. If you're at a dinner party with friends and you ask, is it a good time to buy a home? And some people will say, interest rates are going up. I don't like the long rates right now. It makes it more expensive to buy a home. I live in San Francisco, and geez, the prices are up again. I'm going to stay where I am. My little house is fine. And the other guy across the table says, I haven't really thought about it. I don't know. They are clearly different psychologies. And so that may be what's behind this, is conservative versus risk taker.
Right. And when just to clarify, earlier you were saying that the FICO scores remain the same. Does that also mean that the FICO scores of the loan applicants, the distribution over the loan applicants? Because I guess intuitively I would think that people, all else being equal, people with higher FICO scores are generally going to be kind of more conservative in their, risk-taking behavior. But no,
FICO is just a measure of past luck. You can be a risk taker and been lucky, right?
Well,
and in fact,
fortune favors the prepared.
Yeah, that's true. It's true. Yeah. It's both. And in fact, if you look at average FICO scores through the crisis, they won't move until people default. So going into the crisis, until you're well into the crisis and defaults are happening, you're not going to get a shift in FICO scores. So these risks that we're measuring in 05, 06, 07 aren't going to be picked up.
No, I mean, just to clarify, what I was really asking was a more technical question, which was, do we mean the distribution, the distribution of FICO scores across the population, or the distribution of FICO scores among those who are actually applying for loans?
Well, this is across the population isn't changing.
Right.
And no, actually the loan applicants, if you do this analysis for a slice of loan applicants, and this is what we did, we said, well, let's just take the prime consumers, 30-year fixed rate mortgage, the standard mortgage stuff. It looks by origination criteria to be static, but it's not. Yeah.
Anything more on this before we move on? All right, so I guess I want to make sure we save time for questions. Actually, why don't we see if there's some questions? There are mics, so please go to the mic, and just whoever gets in line at the mic gets to have the questions. No fighting. You have to use the mic because they're recording it, and they want to have the questions on the recording.
Can I ask the question? Okay.
Yes,
so,
please.
I think a lot of you have actually referred to sort of the behavioral or psychological aspect of lending, right? So the reason why relationship lending lasted for so long is there's this ability to repay, there's this risk of default, but another way of actually kind of assessing this in the right way is the willingness to repay, as well as sort of the stigma for not defaulting. And in many ways, the alternative data right now is the social media is a replacement or a digitized version of a lot of the chit-chats that the relationship bankers have actually found about sort of the borrowers. So, if we were to actually go 3 years forward, and if you look back on sort of the alternative data that we're not currently harvesting, to really understand that behavioral behavior, the behavior of the borrower, or to incentivize them for the credit assessment, what would they be?
What's the question?
What would you look at?
I'm not quite sure what the question was.
Sort of the alternative data, what kind of data is not currently harvested to get that insight in terms of behavior?
So in terms of if I may try to rephrase the question, in terms of the kind of desire, I forget your word, you had a better word than I, a desire to repay, a willingness to repay? Are there specific alternative data that may give us insight on that? And also maybe do you see big changes? You would imagine that if everybody's defaulting, why shouldn't I default as well? And so there's some credit cycle. I guess my point is you would think there'd be some credit cycle aspect of that as well.
All I can say is in terms of what data would lenders like, they are trying to collect it all. It's NSA-like, the amount of what they're trying to collect and more. So which ones will signal, where are the signals for the time being? The ones who have answers on that, they're not sharing them.
I think people are still exploring, and especially on the issue of what's stable. A couple of different lenders I work with, one said, we will not do any alternate data sources because we're worried about stability. And I passed this comment along to another group that we're working with, and they said, those guys are chickens. And what he went on to explain that the difference, this second person used to work at a major, pretty sophisticated lender, who he said that at that sophisticated lender, whose name we would all say, yeah, they're pretty good, he said for them to go from data set to model built to validated to deployed, well, just the deployed part is 18 months. And the stuff before that is over a year. And so the stability concern is about if I have something that's based on what brand of cell phone do you use, by the time I deploy that, the world has changed and it's useless. And the other guy who said, we use everything, he said, we have built from the ground up our in-house tech stack so I can go from data set to deployment in 3 months. Yeah. And if the data changes, we're there.
So this is one of the reasons why this actually is a FinTech panel and not just a FinData panel, right? Because in certain cases, you actually need the tech in order to be able to take advantage of the data. Why don't we alternate and go over to this side, and we'll try to get as many in as we can before we're forced to quit.
So banks have been penalized in the past because of bias in lending decisions. With the use of AI, could you give examples of how you control for bias in lending decisions that the model might make because it's driven off of the data set? And if you could give some real examples, that would be great.
Well, what I've seen is people post-processing the outputs to, you've got to look at correlations. And I want to avoid using some names here, but I knew a guy who worked for a famous AI modeler, and his company developed a fraud solution and so forth. And this student told me that, yeah, actually that famous fraud detection algorithm was basically detecting zip code. If you looked at its outputs, it correlated really well, but zip code wasn't an input, so they had no problem with it. Well, I don't think it's that easy today. I know that they would be looking at correlations on the outputs. But there are some fancier algorithms for backing into that. So I don't have the paper references memorized.
So it's super important with respect to bias. And by the way, let me know if I can give you a bunch of references on related things. I don't know if they're going to directly answer your question, but it seems like one of the most important things is to be able to provide explanations of the decisions that are made. Right. People always wave their hands about, oh, it's a black box. That doesn't make any difference. You can explain the decisions that are made by AI systems, whether it's a black box or not. And if people are waving their hands about the fact it's a black box and we can't explain what it's doing, then go hire somebody else. Because basically it's the input-output behavior that makes a difference. So we should be able to explain the difference in cases where it's going to be making a big, especially in consumer credit, where it might be having a big impact on somebody's life.
Thanks.
Hi. One of my observations from the crisis back in 2009 is that credit models are traditionally made looking backwards, and I'd like to have your comments on the use of alternative data to help with forward-looking risk indicators.
I'm actually a firm believer that all crises are pricing failures. That what I saw from mortgage lenders in 2005 and 6 and 7 is that they were pricing for previous loans in the previous economy, not for the loans they were booking today. They were basically using roll rate models. And so if you get the pricing right, and let's say it differently, just using ordinary data, if they had been forward-looking instead of backward-looking, using ordinary data at the time, pricing correctly instead of pricing subprime loans like prime loans, much of that wouldn't have happened. Now, of course, I think you can do better than that, potentially, with some of these other data sources as well. And as my co-panelists here have said, that in other parts of the market, you really can't do thin file lending very well if you don't have alternate data, those sorts of things. So you can't price in the beginning without that.
Let me take my prerogative as moderator, because we're just about out of time, and Carlos has been waiting patiently there. And so why don't we take the last question from Carlos?
So one of the things that I've been thinking is like one of the challenges of actually acquiring this alternative data is to actually purchase the data or to build the systems that are going to go out there and try to gather this information from informal sources, right? And then like once you get this data, the usefulness that you would get out of it, it's going to depend on the predictive task at hand, right? Like it could be super valuable to predict for certain people, but not really valuable for something else. And at the end of the day, it's like an economic decision of whether I should invest in this system to gather this data or should I purchase this data or not. And I've been wondering if you, like, how would you put a value to this data? How would you decide whether to build this system to gather this information? Thank you.
I mean, I can tell you what the people I work with, it's all still regarded as innovation. And so, as I was kind of tongue-in-cheek saying before, we'll know a few years from now if the fact that the loans that were originated and the credit were extended based on these models actually works out. And to his point is like, you know, it's all a pricing error. So were you pricing the right things at the right point and to the right people? I think we're too early in the cycle. So far, they seem very excited, but you know, everybody's excited until something happens.
Inevitably, we're going to be wrong. It's just the nature. Every model works until it doesn't for a period of time. It's just the nature of what we do. We're trying to be perfect, and there's no way we're going to be perfect. So the question about how do you decide, that's a cultural issue. It's not necessarily a data issue. And the culture, if your culture is that of innovation, then you're always going to be looking for the next best thing. And so that's a cultural thing. We're not going to know. We don't know what we don't know. That's why we explore. And through that exploration, we hope we learn something. Sometimes we don't, and we waste our time and money. But without the effort, we're never going to learn anything. So we're exploring.
Yeah, and 2 years from now will be different. And 3 years from now will be different. It will be a constant adjustment. And
Okay, we're out of time. Join me in thanking Eric and Alberto and Joe for the panel. Thanks.
Thank you.